All right, let's do this.
All right. Well, welcome to the REI Mastermind podcast. I am your host, Brandon Simmons, and I am here with Dave Gudmundsen. He's one of my longtime friends, mentors, and we're going to be talking about seller financing and creative financing specifically today. So now, if you're watching this on Facebook or on YouTube or Periscope or anything like that, if you have any questions that you want to share, please go ahead and try to throw those in the chat. I'll try to get to those as we're going throughout this. But I want to kind of get started, give you a little background on Dave. You've been doing real estate for how long now?
Since 95. As my kids refer to as the 1900s.
The 1900s. There you go. Now, you've had a chance to do several type of creative financing deals, right?
Yeah, hundreds maybe.
Hundreds
Thousands,
of deals.
Yeah, a lot.
A few of them. Okay, so now we're going to kind of get into this and talk a little bit about the type of creative financing deals that are out there, how to figure out what type of creative financing to propose to your seller, and also basically the ins and outs, like the details, the nitty gritty stuff, right?
Do we have the board to sketch it or no?
Oh, not at the moment.
That's all right.
So
we can ad lib.
Yeah, we'll kind of ad lib. So let's talk about what is creative financing.
Okay, I would say it's anything other than, you have a couple ways to purchase property. It's one, cash.
Mm-hmm.
Okay. Two is a conventional source of funds, bank, mortgage broker, etc. And then three would be alternative source, which could be creative financing, private financing. And we're not going to talk about hard money lending. We're going to talk more about, seller finance deals,
right?
Whether it's free and clear and the seller be in first position, or if you're wrapping an existing loan. So
okay, so let's kind of dive deep. Let's give us a little bit of background on some of the, maybe a couple of deals that you may have done, or how do we decipher? So
let's break it down and figure out free and clear, not free and clear.
Yeah, so free and clear, when we have a free and clear property versus a property that has a encumbrance or a mortgage on it, what do we do?
Okay, so if you want to, so we'll do it in two different boxes.
Okay.
Box left is free and clear property. The seller owns it free and clear. And there's still a lot of sellers out there that own it free and clear. And then the other one would be they have some kind of loan on it.
Okay.
And you'd want to find out if it's conventional. Let's just make the basics. Conventional, FHA, VA, and probably like a private financing deal, which would be...
These are the type of loans.
Correct.
Right. Okay.
Like the person used some kind of private money, whether it's from the seller they bought it from, a family member. There's some private loan owned by an individual.
Lender.
Yeah,
it's not a Wells Fargo or something.
Exactly. Like so you'd put, and if it's free and clear, it's a lot easier to do it if it's free and clear.
Okay.
Because you can make the terms any which way you want to, as long as both parties agree and it falls within state laws.
Okay.
So, and every state's going to differ. We're here in Arizona, and we do what they call deeds of trust versus a mortgage.
Okay.
And then let's even talk about that for a second, because you have...
Okay, now you're going down a rabbit hole here. All right, so deeds of trust and mortgages.
Okay, so a lien, like a loan, let's just say I owe you $10. I write on a napkin, I'll give you $10 in a week.
Okay.
That is a note or an IOU.
Got it.
A deed of trust or a mortgage is what secures that loan against that real estate. Does that make sense?
Okay, locks it.
Yeah, absolutely. Okay. So in Arizona, we predominantly do deeds of trust.
Okay.
So,
and some states have
mortgages where you have to go through the courts to foreclose, judicially. Okay. Versus here, deed of trust, it's through a power of a sale through a trustee, where it's a lot simpler.
Okay.
So if we're going to do an owner finance deal, a couple things. Well, what's interesting is, let's even back up. Why would somebody want to carry?
I don't know why.
Well, it's interesting because everybody thinks, even the sellers, I can't tell how many deals I've done where, I want cash. Well, why do you want cash? Well, because I want cash. Okay, as soon as I give you the cash, what are you going to do? Well, I'm going to put it in the bank. Okay, what are you going to make when it's in the bank? Oh, I don't know, maybe 1%. I don't know it's even less than that, 0.5%, 1/4%. Heck, you're lucky if you can get 2% in a CD right now. So you have to ask the whys. And a lot of times I'll tell them, listen, I'm not trying to be intrusive. I just it's going to help this transaction the more we know about
Right.
what we're trying to accomplish.
Right.
So, and I'll tell them, I say, hey, instead of you taking this money and making 1 or 2%, why not try to make two or three times that? I say, hey, if I was able to give you some cash at close
Mm-hmm.
and a nice passive income minus any landlord or maintenance responsibilities, would that interest you? Well, yeah, that sounds really interesting. Because a lot of times they get out of.
So is that kind of like your script that you use?
Yeah, absolutely. Because
that seems really simple.
It usually is, because you find out what their why is. A lot of times, well, I don't want to carry because my uncle 20 years ago had to take a property back. Okay, I mean, that's like saying, hey, one time I drove my car and I got in an accident. Therefore I'm never going to drive. I mean, it makes no sense at all. So I'll tell the seller that we'll set up a transaction where you're, obviously you're title insured, you're going to be fire insured, meaning you're going to name this as additional insured on the insurance.
Okay. All right.
You can even set it up with you want to take all the worry out of it for them.
Okay. So let's go with the scenario. Let's go like maybe you have a case study that you can share.
Okay.
So let's say they have a property that's free and clear. They don't have any mortgage, no deed of trust, no loan. They own it free and clear.
Okay.
Do you have a scenario or a case study like that?
I have several. So I had one where this lady she had to get her price.
Okay.
And you ever heard the thing, you pick the price, I pick the terms?
Yes.
Where it's like, hey, you pick one, but you're not picking both. So, she picked the price and she had to get, and I think of it, this is several years ago, where she had to get like 20-something thousand for this thing. It was some mobile home and, AJ, Apache Junction. And it was kind of a dog, but she had to get 20-something thousand, and she wanted like, say, I think it was 4,000 down. So,
okay.
And let's just say it's 24,000. I put 4,000 down for, and she wanted to finance $20,000. Okay. And this is what we did is I said, okay, if I gave you $500 a month for 40 months, 500 times 40 is 20,000.
20,000. Okay.
And I said, would that work?
And
yeah, sure, that would work.
Because you're giving her 20,000, what she asked for.
Yep.
But what you just did though is you just created a note or a loan with no interest rate.
Yeah. Or we call it principal payments. So sometimes
principal
people choke.
Only payment.
Yeah, they'll choke on the 0% interest. So I said, hey, if I owed you $1,000 and I said, hey, tell you what, I'll pay you $100 every week for 10 weeks.
Okay, hold on. Let me go through this again. So, $24,000 property. Mm-hmm. She wants $24,000. She'll take $4,000 down and will carry $20,000 back.
Correct.
And you offered to pay $500 a month.
Yeah, it's either $400, $500 for 40 months or 50 months, something like say $500 a month for 40 months.
And basically it's all principal payments.
Correct. No 0% interest. Because she had to get her. It's so funny. She focused so much on her sales price. She probably, I'm going to sell this. She's probably telling her family, I'm going to sell this thing and I'm going to sell it for exactly this. And how much did you sell it for? Well, I sold it for what I told you. I'm right. Sometimes people want to be right.
Yeah, they always do.
So, and that's how we did it and sometimes what you'll find is if you can take the worry out of them, just say, listen, it's title insured, it's fire insured. We're going to set it up through account servicing. Like right now is tax time. Everyone's getting ready to send out. I have to send out my 1090, 9s and 1098s and all that stuff.
Yeah. No
seller wants to mess with tax forms unless they're an accountant. They don't want to fool with that nonsense. So have it set up through an account servicing company. You can find them. Most title companies have their own division of account servicing companies.
How much does that cost?
$10, $15 if I'm guessing. Yeah, every title company is different, but $10, $15 is something like that. Okay. And they might charge a little more for add-ins if you're impounding taxes and insurance and that kind of thing.
Okay.
So a lot of times if the seller's really worried about, I don't want to have to worry about if you're paying the insurance. I don't have to worry about if you're paying the HOA. I don't have to worry about if you're paying the taxes. So you could do a concurrent payment clause that makes multiple bills due at once.
So it's paying to everyone that's
absolutely
connected to that property.
I had one where I sold on an owner finance deal and I was worried about them in Casa Grande. I think it's Casa Grande and some of the other Pinal counties where you have to pay the sewer separate. And every month you get the sewer bill, it's $40 or whatever it ends up being. So I want to, and they'll lien the property if it doesn't get paid. So you could require when I sold it on a finance deal. I said, hey, we're going to pay, principal and interest. I want to impound for taxes and insurance. And then you could even impound for an HOA and a sewer bill.
Okay.
That way you just make it
It's
simple.
all one simple payment.
If you want to travel, if the seller's traveling, they want to travel all over the world, direct deposit in their account, they don't even have to go to the bank and mess with the stuff.
Okay, so that's a scenario that you did of a seller carryback with no interest, basically it's principal.
I've done a couple of those. That's
principal only interest. But so tell me how the pitch is. What how hard is the pitch?
Well, sometimes these deals are like, hey, listen, either one or two things is going to happen. One or three things is going to happen. One, somebody's going to come up and pay cash, and they're going to beat you up on the price.
Right.
Because for some reason, a lot of times the properties that we all buy are hammered properties that are probably going to be tough to finance. Someone out there might, but I mean, forget
especially you've done a lot of mobile homes, and a lot of mobile homes are
mobile homes, land, commercial, all that stuff, fixers. A lot of lenders don't want to mess with that. If they go in, there's a hole in the ceiling and things ready to collapse. I mean, they're not going to fund that thing.
Right.
And good luck trying to mess with like a 203K FHA rehab loan. I mean, forget it, So yeah, it's kind of the easy solution where it's like, hey, because even, I recently sold a commercial building I had, I think it was last year sometime. And I didn't want the cash. It's like, okay, great. I'm going to put it in the bank and make, you know what I mean? Because when the sellers own these properties, they feel comfortable with them. So what better of security to have than something that they've owned for 2 years, 5 years, 20 years, 50 years. So even on this strip mall shopping center that I owned, I said, hey, I wanted enough down payment where I didn't have to worry about, getting it back.
So you did a seller financing
absolutely
to the buyer. Okay.
Absolutely. And I loved it where every month, you have so much money drop in your account. I mean, on the small deals, it's, $400 or $500. On the bigger deals, it's $4,000 or $5,000.
Okay.
So it's a good passive income without the maintenance and the management nonsense and all that.
So so basically you're kind of turning homeowners into private lenders on this as well.
Yeah. And not hard money lenders, because you go to hard money, they're going to want 10, 12, 15, 18%.
So what type of interest rate do you usually try to negotiate?
I had one, it was funny. I did another one on a property in West Phoenix, and they owned it out of state.
Okay.
And I told her, I said, hey, I'll pay you 5%. 5%? I'm like, oh crap, I just ticked her off. Why would you pay that much? Because the bank's loaning at 3.5. I'm like, she thought it was a scam.
Yeah.
I said, we could do less if it make you feel better. But a lot of times I'm fine paying 5%. I'll do that, all day long. Now the rates have gotten really low.
You helped me get one of my first rentals doing a seller carryback, and I got 5%.
Yeah. It's kind of that sweet spot. It's just, it's a good one where they're getting enough.
Yeah.
Where you start going too low and they're like, you know what, I'll just take my money and plug it into a CD. And if I want it in 6 months, I can go get it.
Yeah. Because
they have to know that when you're doing a loan, you're locked in.
Yeah, they can't.
It's tough to sell these. You can sell these loans, and I've bought, I've bought
notes.
Notes before. And remind me, we'll talk about the clauses you want to write in on some of these things to give you opportunities that if something happens.
So let me explore this for a second. So on the turning these homeowners into private lenders, you're not paying like 18% interest. You're paying like 5%, 6%, 7%, something like that. Tell us about. I remember we helped you put a deal together where you try to pay off the loan and the seller did not want to do it.
Oh yeah.
Chandler,
okay. Yeah. It took me a minute to figure out which one. I did that twice. And you could put
they didn't want the money back, right? You sold, you fixed the deal, you fixed the house.
I oversold. I said, oh man, it's great. You're going to get this income coming in and you can do whatever with it. And then I call them and say, hey, I'm selling this one. I'm going to pay you off. And no, you're not. I'm like, well, I have to. I'm getting the money. I sold it. It's getting paid off. So you could do, and I coined the phrase, walk the mortgage.
Okay. Walk the mortgage.
Or it's like a substitution or collateral clause. Because you think about it, in a deed of trust, like a mortgage,
it's connected to some real estate, some real property.
Absolutely. So you could put in there in your terms on like when you're writing up this note and deed of trust.
Okay, this is blowing my mind. Okay, good.
Okay, well, let's just say you're doing when you're buying this thing, and we'll go through, and you'll have the form, I think, on your
I'll
site or whatever.
If anyone that wants to get a seller carryback form for free, just make sure you put your email in the comments, or email me at simcohomes@gmail.com and request a seller carryback form. Just type in seller carryback form and your email in the comments, and we'll get you a copy.
And it's going to be a basic one.
Yeah,
and
it's one we both have used.
It works, because what you want to do is you want to give the title company just enough information to do the paperwork.
Okay.
Trust me, I'm not the one drafting out the note and deed of trust.
And everything.
Yeah, forget it. I mean, that's above my pay grade. So, I mean, just let the title company do their things, but they need instructions as like the contract.
Okay.
What are the plugins? What are we going to?
Well, what are the basics in that seller carryback document? So
Good
you
question.
have a purchase contract, and then you have the addendum, which is the seller carryback.
I'll pull
addendum.
it up here. So basically, you want like the loan amount. That's the most important thing.
Okay.
So in order to figure out a loan information, you need 4 different things.
Okay.
Okay.
4 things. All right.
And I'll tell you what, it's important if you're ever doing these deals, you can get the app for like $5. It's like a Hewlett Packard 10B2, the calculator. Yeah. So
well, I even have a dumber down version of the mortgage calculator. I just plug it in and spits out.
Yeah. You just need, so you need to know number of months.
Okay. The loan amount.
Loan amount.
Okay. Loan amount, the number of months.
Number of months, interest rate, and that'll solve for the unknown, which will be the payment or any one of those. So as long as you have the 3, you know what to solve for. So they could ask you, hey, I want to have, let's just say it's 5% interest. The loan amount's going to be $100,000. They say, hey, I'd like to have payments around $800. You just solve for how many months the loan needs to be for. So those are the 4 things.
And how much typically, now you've done deals where it's both principal and interest combined in that monthly payment. And then you've done it where it's principal only. Yeah. Yeah. And have you done interest only as well?
Probably, I'm sure I have, but my thing is I like to pay down my debt.
Like to pound it down.
I like to pound it down.
Yeah.
I want no prepayment clause on any of this stuff.
Okay.
So anytime you set this up in the payment thing, it'll say like the payment will be $500, comma, or more. That automatically applies. There's no prepayment penalty.
Oh, really?
Yeah.
Okay.
And then let's see what else. I'm just looking at this thing. The title company want to know the intervals. Is it paid monthly? Is it paid annually? Is it paid quarterly? It's either, if you're doing a short-term deal.
Let's just try to do something really simple and basic. Let's try to walk through a simple seller carryback, what you would put into it on let's say it's $100,000 loan. Yeah. How would you?
I would do it. Let's just say if you just want to do it super simple, you could just do, hey, you know what? I'll do a 30-year loan. Okay. Maybe 5% interest, and the payment will be whatever.
Okay. And so if I use my calculator here, I'm doing this live here.
See if he's going to screw up.
I probably will. That's okay.
So 360 months, 5% interest, $100,000.
Loan amount is for $100,000.
Correct.
And we're doing 5% interest.
Correct.
Over 30 years or 360 months. So according to what I got calculated here, I have a monthly payment of $536.82.
82 cents, exactly right, 100%.
Wow. Okay.
So
now on that first month, now the interest, looks like the interest and the principal will change depending over time, right?
Yeah, and that's why I think these calculators are important, because what you have to look at is I'm running amortization for the first year, and it's like
for those of you who don't know, I don't know if you can probably see it. Gosh, no, you can't. But I just use a simple mortgage calculator that you can download.
Yeah, and that Hewlett Packard one's really good. Like the first year you'll pay $1,500 interest and almost $1,500 in principal, but $5,000 in interest for the first year. So you could even show the seller, hey man, you know what? You're making $5,000 in interest. That's just the gravy. And as time goes on, your interest
starts to go down and your principal payments
go up.
So like on something like that, what type of cash flow are you shooting for on something like that?
I like to make 20%, 18, 20. I mean, that's tough to do now. I mean, that's,
okay.
That's why I've been.
But so 20% on that's what, $100 or more?
Depends how much you're putting down. So
okay, a couple $100 cash flow.
Yeah, let's just say if you put 10 grand down, if you wanted to make, 24% return, you'd want to clear $200 a month.
Got it.
Okay. I mean, the trick is, I think you have to have your secret sauce and as you know, the market's hot right now, so it's tough to get double digits. It's everything,
right.
So,
but whenever, through your experience, whenever you've discussed with sellers, do they even know that this is on the table or an option?
no, that's what's so funny. I've rarely had, unless they're savvy and they say, listen, my accountant says I need to sell this on an installment sale or a seller finance deal, that a lot of time, and you have to be careful about giving tax advice as well,
right?
Where you could say, hey, it might be, have them check with their CPA.
Now, you're not an attorney or a CPA.
CPA.
You're not, okay. He's not giving any financial or legal
no financial advice. But a lot of times they'll go have them talk to their tax advisor, and they might advise, hey, you know what, it might not be a bad idea to sell this on.
How adversarial are these negotiations?
Oh, it's great. They love it. They're just like, oh my goodness, like that one, back to the story where the lady thought I was scamming her.
Yeah.
Where it's like, well, why would you pay 5% if you can get it at the bank for 3.5%? I said, well, the problem I have is this is back in the day where if you had more than so many loans in your name, I forget if it's 8, 10, or 12, you couldn't get financing, period.
Well, I think I used to be an underwriter at Wells Fargo, so typically they stop you at 4. You may get special exception up to around 10, I think.
Yeah,
now.
And then unless you go with some kind
10,
of a
something like that,
special lender or
right.
portfolio lender.
But this
or
is through like the regular.
Yeah, the normal sources.
Yeah.
So, and I told her, I said, listen, this is great. I mean, you get cash at close, you get a nice monthly gravy train coming in, and it's secured by the property. All the stuff. I mean, there's not a whole lot can go sideways unless you don't make the payments.
Okay, so you're leveraging the seller's equity.
Correct.
They're acting as the lender, and they're happy because they're getting payments every month.
Yeah.
Now, what happens if, let's say there's no balloon payment, like that means you don't have to pay it off early, but then they call you up and say, hey, I want to get money out. Has that ever happened?
I had one on a private lender where they lent us money, and it was family friends, so I cut him a check. But yeah, I mean, the reality is it's a note. It's tied up for that time.
Okay.
But there is something that you could put in a couple of the things you can put in your thing is a couple different ideas. One, you could do trying to remember. So the substitution of collateral thing we talked about, and that gives you the ability to move the loan. You have to be careful though, because sometimes it could put the seller at greater risk. I even had one where I had this two where we moved him. The one, he went from a first position to a second position.
So
he acknowledged that.
Yeah, they sign typically like a subordination clause.
Yeah, exactly. 100%
so
right.
Now I got a couple questions on here. So one of them is, can a seller carryback work in Texas or in other states?
I do business in Arizona. I've done business here, Indiana, and California, and I'm sure it can. I'm sure you can carry anywhere. You just have to find out.
I think the key is, in Texas, it's more about selling that note or trying to wholesale it and stuff like that is really
and I just don't know.
It may clamp down a little bit.
Yeah, but I mean, from my understanding.
But if you're doing it for your own private porportfolio,
and the only other elephant in the room is the whole Dodd-Frank Act, but I'm not even going to get into that nonsense, because when you're buying it, it's just like, hey, the seller owns it in their own name. They're selling it to you. It's not their primary business, flipping homes. So a lot of this stuff is probably exempt.
So this is a seller carryback, and you can fill out the addendum. You can put in there if is there a due on sale clause?
You know what's interesting is in Arizona, in the AAR contracts, the Arizona Realtor contracts, the default clause is to have a due on sales clause. I never want a due on sales clause when I buy this stuff, and I'll tell you why. Because let's just say, you got a deal where maybe you bought it at 5% interest, and let's just say even if you sold it for the same price you bought it for, you could still make money.
Yeah.
Because you're making it on the spread, on the arbitrage, the spread between, let's just say you buy it you get the seller to carry it 3.5%, and then you sell it at 7%. You're making a spread.
That interest.
Yeah, 3.5 off.
Nothing. This thin air.
I mean, that's what the banks do. They borrow this and lend it at that.
And that's why they have the big buildings.
Exactly.
So that's seller carryback where they own it free and clear.
Okay, let's talk. There's one other clause that's worth doing, and I've done this before. It's called the first right of refusal, where if that loan is offered for sale, you have the first crack at it.
Okay.
And what's interesting is like a lot of times I bought this other
Because
property.
they don't typically sell the loan for face value, right?
No,
They
no,
usually
heavens no.
sell it at a
Yeah,
discount.
big time. So, and there's a difference. It's complicated figuring out note values. There's a difference between discount and yield. It's complicated as heck, and it's another podcast. But the short answer is it's not going to go for it's going to get a discount.
Got it.
But what you find is I had this one. It was interesting. I bought this property, and I assumed the loan.
Okay.
There's a private note that was assumable. I assumed it, and it actually went into my name or my LLC's name. Okay. And then I sold it on a wrap. We wrapped the loan, made a new loan. And the trick, you've heard different things, all-inclusive deed of trust, a wrap, an agreement for sale. There's so many.
You're gonna make their minds
it's going to explode.
Yeah.
So,
but you can basically get a loan locked up, sell a carryback where they own it free and clear.
Yeah.
And so the most important clauses on that are don't have a due on sale clause.
Yeah.
And
it gets complicated if there is. I mean, if it's a bank, we'll talk about that kind of thing.
But this is the owner owns it free and clear.
Yeah. It's like if there's a due on sales clause on a private note, they're probably going to know it transfers.
Okay.
And you know what's funny? You know how anyone ever finds out it transfers?
Someone calls them up or tells them or sends them a letter or something.
Sometimes, but it's usually the insurance.
Okay.
Because all of a sudden they get a new thing that says additional insured John Doe. Wait a minute, I sold it to, Dave G.
Right.
Why is John Doe? Why is this in John Doe's thing? Who's that's how even banks, that's sometimes how they find out, is they just find out they're trying to figure out the new insurance thing. Okay, there's new insurance. Who's this other guy that we don't know about? So
let's go through the if this and that type of scenario.
Okay.
So if they have no loan, then we can go down the seller carryback.
Yeah, deed of trust.
Okay. We can do pretty much what they have no loan. We can do all sorts of seller creative financing.
Yeah,
stuff.
It's super easy. You can structure the terms.
You can do lease options on it.
Yeah.
You can do a land contract or.
Yeah. If I had a choice, if I'm the buyer, I would want to buy it as like, let's talk about stuff with the best way to hold it versus the least. Obviously, the best way is owning property free and clear. You're the person.
Got it.
And then I would want to hold it with somebody having a deed of trust secured against it. That way, I get the warranty deed. The title conveys to me.
So you have legal title
and equitable title. Yeah, both. Okay. Now let's talk about if there's a loan that you're making a new loan over, which is called wrapping a loan.
Okay. And I love this because not a lot of people know about this, or maybe they know about it or they don't know how to do it. A lot of people are familiar with subject to.
Yeah.
Basically where they sign the whole loan and title over to someone, right?
Well, they'll probably sign the deed over, but then you're taking it subject to the underlying loan.
And
I never do them that way. I always just a lot of times.
So tell us wraps. So we're going to go into wraps and tell us the difference between wraps and subject to, because there's a lot of people doing subject to now.
Yeah.
And I want to talk about pros and cons of both.
Yeah. And I can talk, because and I've read some of the, my dad's background is law, and I've read, he had this book on real estate, and I kind of read, talking about, and I won't get into the subject to stuff.
So you're an expert because you read a book now.
Exactly. But no, it only told you that the two, it was like agreement for sale.
Okay.
And deed of trust.
Okay.
Okay. And I won't get into
which
the
is seller carryback.
Yeah. And I won't get into the subject to stuff because I don't do it that way.
Okay.
So I'm probably not the guy to talk to about that one.
Got it.
So on an agreement for sale, what's interesting is this, let's just say you're the seller, I'm the buyer.
Okay.
Okay. You sell me a property, $100,000 loan. You have a $50,000 loan on this property.
Okay.
I'm buying it for 110. I give you 10.
Okay.
And then we're making a new loan encompassing that other one. So you have the $50,000 loan here. We're making a new loan of 100.
That existing loan.
Exactly. Between you and I.
This is the 50. Is it a?
It's $100,000.
The loan's for $100,000.
$100,000, and we're going to write it as an agreement for sale.
So they owe $100,000. They're selling to you 110.
Correct.
So that's not a lot of equity.
No.
For them.
And it's interesting the way it's written is based on the down payment is, and I'm trying to remember the dates, and the Dodd-Frank stuff might skew it a little bit because I don't, all that's admin stuff.
And every state's probably different.
Yeah, every state's different. In Arizona, it's if I give you 0 to 19% down, I think it's 30 days foreclosure plus a 21-day period. And then
Okay.
it goes up to 60 days plus 21, then 90 plus based on if you're, 0 to 19, 20 to 29, 30 to, it just goes from
and
there.
this is helpful to the seller because why?
Well, let's just say, you could just say, listen, I mean, they're not going to understand all this nonsense anyway, but if they're savvy enough, you could say, hey, we're doing this on an agreement for sale. And if I screw up and don't make the payments, doing it through a deed of trust is 91 days minimum. That's before any of the Dodd-Frank crap.
So
It's quicker foreclosure.
You're acting like a fiduciary. You're trying to help look out for them by giving them a little bit in case something happens.
Yeah.
They
Hey,
get
what
the
happens
property
if this
back
thing
faster.
goes, like my mind would think is if this goes south, what are my remedies?
Yeah.
You get the analyst guy that's going to want to know this stuff. So, and then the other thing too is on agreement for sale, you retain legal title and I have equitable title. So it's almost kind of a cross between like a lease option deal and a deed of trust deal. It's somewhere kind of in between if you had to.
Because you're making monthly payments.
Yeah.
And does the principal payoff go down?
It does. Because we have a new loan between us of $100,000.
Okay.
So, and then the most important thing is that this is what's interesting is every month, maybe I'm giving you $1,000. You might take $500 and pay that underlying loan. And then you're getting that spread too of another $500. And then you could even, this is a good pitch for the investors out there. Okay. Let's just say if this person has a 3.5% interest rate, you have a 3.5% interest rate on that 50.
Okay.
I might pay you 5%, right?
Oh, wow.
So you're getting 5% on your equity, which is that 50. And then you're getting a 1.5% override on the loan between you and the bank. Does that make sense?
Yeah. So it may be a little confused because it's a lot of numbers.
I know. I wish we had the board to draft it up and show it.
But let's just go back to the basic elements of a wrap real quick. Okay. So,
and let's
say I have a loan for $100,000.
Yeah.
We wrap that loan.
Well, in our example, you had a 50 to the bank, and I was buying it for you, giving you $100,000 debt against the property.
Oh, okay.
Okay.
Okay. So then it's the new loans for $100,000.
$100,000. You have legal title. I have equitable title, and then I forget what the terms are. The legal terms. I don't remember what.
But even if they don't have equity, even if they don't have that much equity, there's people that it's easier for them to sell it with less equity. Like they're more likely.
Oh yeah, because it's just like, hey, you know what? It's worth. Maybe we agree to a sales price of $100,000, and they own 95. I mean, they can't list it, go through getting a new buyer with all that nonsense. Yeah. I mean, their money's gone. This thing, they'll at least get something.
Got it.
So, and you tell them, say, listen, it's going to go quick because we don't need it. There's no appraisal. There's no nonsense. You inspect the property and it's done.
Why would you do a wrap instead of a subject to?
That's what I know.
Okay.
I do agreements for sale.
Agreement for sale.
Yeah.
That's what they call it.
And like I say, I'm not saying, all I do is agreements for sale.
Now, have you ever sold or assigned an agreement for sale deal?
Yeah, I've sold them on that, and I've actually had to take them back. And this is an interesting thing too. This is what's really interesting. There's no a deed of trust here. It goes to auction at a public sale. If this is a great property and you want it back, you sell it on an agreement for sale. There's forfeiture. It comes back to you. There's no public sale.
Oh, it goes right back to you.
Yes, that's interesting because let's just say, and it depends on what kind of down payment they put in, all that. If they put a huge down payment, it takes longer to do.
Okay.
The foreclosure.
But the forfeiture comes back.
It's forfeiture, yeah.
Oh, okay.
No public sale.
And no, I've heard of people, and maybe I'm going a little off topic here, but I've heard people whenever they're doing wraps or the people that are savvy to understand when they sell a property on agreement for sale or wrap, they will also maybe reach out to the seller if they're behind on payments and have them sign a deed in lieu of foreclosure. Yeah,
I've done those before too, where I've banked a lot of properties where I've sold it and carried it and that kind of thing.
So basically, it just goes right back to.
Let's just say if I sold you a property and you didn't make the payments. But this is the most important thing if you ever do that.
Okay.
Since you've owned the property, if you're not paying me, you could not possibly not be paying other people. So when I take that property back, I'm taking any liens that may have attached to that property back.
Got it. Okay.
So you want to go through title, have them run a title check, go
Make
through title,
sure.
man. Don't try
Yeah.
to save a buck, and because you could have
Yeah.
5 liens or judgments
Okay.
that have attached to that since I sold it to you. But when if that was the case, I would just say I'm taking it to foreclosure because it's going to burn those off.
So these people that have some loan on the property, some mortgage, some deed of trust, you can easily wrap that or do an agreement for sale on that. And you've done this more than once.
Oh yeah, I've done dozens.
So you can have, I mean, you can create a whole rental portfolio out of this.
Oh,
right?
I did. I have. Yeah.
Okay.
But this is the thing too. Okay, let's talk about that. Let's talk about the different, like the loans. Okay, so private loans depends on if there's a due on sales clause or not. Okay. And then, not to backtrack, but the one I did where I bought the property, assumed it.
Okay.
There's no due on sales. I sold it to somebody. We wrapped that loan. I made a higher interest rate, increased the loan amount.
Created money out of thin air.
This is what's interesting. I contacted the guy that held the note, and I actually paid him off and got a discount, I think, of almost 10 grand. Wow. And it was a small loan. I think it was only like 30 grand or something like that. He discounted 1/3 of it or something crazy like that. So all of a sudden I owned that sucker and I was getting all the money. I didn't have to pay anything to any underlining. So so let's just say, okay, so remember we had, it's free and clear or there's some kind of loan or encumbrance on the property. Okay. Conventional loans, and like I said,
that's what I was just going to ask you. What loans can we wrap?
And I'm not an attorney, but based on my experience, I have wrapped conventional loans.
Okay.
I've done conventional loans that are adjustable. That's tricky.
Okay.
Because you have to find out what it's tied to and when it adjusts. Is it tied to, I can't remember. I mean, you're a banker. I mean,
so it's not a fixed amortization schedule there.
So it's tied to prime, or it's tied to the cost of funds index. Or
so the payments may go up or go down.
Something. I forget what this, Okay. It's tied to something. So you might have something in there that if I was the seller selling it this way, I would want to have, hey, it's tied to prime +2. So anytime prime adjusts, it's going to go up by that amount.
Okay.
So
got it.
That's what adjustables are tricky. I mean, they're really tricky.
So basically conventional loans.
Okay. I've done VA.
Okay.
And there's 2 types, in my understanding, there's 2 types of VA loans. There's VA loans, and then there's VA repos that sometimes back in the day, they used to finance those as vendee loans. But I think to my understanding, both of them don't have double check this, but I don't think they have a due on sales clause. And they actually, I've heard, this is years ago, that they acknowledged that they did allow those to be wrapped.
Okay.
To my understanding, verified, I mean, it's been forever since I've done VAs.
You've done VA, you've done conventional.
Done conventional.
What about FHA?
Funny, back in the day, I mean, this is like forever ago, but you used to have these loans. This is when I first started, man, in the 90s. You could assume these things without qualifying. In the 80s, they had all these loans and they quit doing it, I think, on December 14th, 1986. And then
that's a specific date.
Yeah. And then March 1st, 1988, I think, was for the VA loans. But before then, if they originated before those dates, they were fully assumable, no qualifying. It was insane. And as you can imagine, they took a bath because, the guy got it who qualified, but after that, the guy was a disaster. And it went, and stuff. So back in the day, and I think VA or FHA loans are still assumable with qualifying and probably have to be an owner occupant. I don't, most title companies won't do FHA wraps, to my understanding. And it's been years since
they kind of stay. The ones that I've dealt with,
I heard their bonds will get snatched.
Try to stay away from them.
So,
but they're usually out here. Most of them that I've worked with, conventional or VA or
VA private
FHA, they kind of stay away. But so what happens? Let's say you do have an FHA loan, and the person really wants to just be done with the house. Maybe they're tired landlords.
Yeah.
What options do you have left?
Well, you have to look at what's going to give you control.
Okay.
Maybe not ownership, but control. I mean, what's the difference?
Right.
You know what I mean? I mean, it's 6-1.
Control without ownership.
Exactly. So I think if you can control it, so you could do, I had this one deal that I only brokered the thing. I wasn't the buyer. It was 13 units in North Phoenix, Sunny Slope area.
Okay.
And the title company, we set it up as a wrap. We're going to do an agreement for sale on this thing.
So a 13-unit apartment complex, you were going to do a wrap on it.
Yeah.
Okay.
We send the title company, I can't believe it. They sent they fax back when they used to do faxes. They fax the bank, small bank in Colorado, the thing that says, hey, we want a status statement, because you want to make sure when you're doing a wrap, first of all, is this loan current, man? I mean, you could find out that this guy's 6 months behind.
Oh,
and you're taking it over and making the payments, but guess what? The payments have to be caught up.
got it.
So the title company, if they know what they're doing, and most do, some don't,
Mm-hmm.
they're gonna want to get some kind of status. Heck, if you get a monthly statement with this person, it'll say what the interest rate is,
Right.
it'll say what the loan balance is, it'll say what the PI payment is, and probably if it's current.
So it gives you all those
All the
numbers
goodies.
that you're wanting
Yeah.
on that.
You need the three of the four. You need the interest rate, the payment
So you
amount.
can solve for the fourth.
Yeah, and the
basically.
principal amount. So they faxed the bank and said, hey, listen, we want to get, it's our intention to wrap this thing, and we want to get a status statement. The bank sent back notices, absolutely positively, you will not wrap this. We will call the loan due.
So then you just fold it up and you just said, okay, no deal. We're
no
done.
deal. Yeah. This guy had already ordered all the windows for the place. He was going to renovate this complex, and he
geez.
ordered all the stinking windows. I couldn't believe it.
Okay, so you
You know.
open up the creative mind
Yeah.
on this deal, and you say, okay, they won't let me wrap it.
Yeah.
They have a loan on it. So
Mhm.
you can't just like carry back necessarily. You can't wrap it. What do you do now?
We did an advertising lease with the right to sublet.
Okay, so you did
So
an amortizing. Okay, you may need to
I
explain.
didn't even know what that was before.
You
We
may
had
need
to have
to
an attorney.
explain this.
Basically, what it is, it's basically control of
This
the
isn't
property.
a lease. Is this a lease option or lease purchase?
I don't even know, man. We just did it where it was set as a certain price.
Okay.
He was getting pay, and like I said, attorney had to structure this thing. Was so stinking
So if I'm
complicated.
thinking of the word amortizing, that means the amount that's owed goes down over time.
Correct, and you could whether he pay, and that's what you'd have to figure out is
So it is like a lease purchase. It's
Yeah.
just so the amount he can buy it for goes down
Yeah.
over as you make it.
and I don't remember
payments on
what
this.
percentage of the lease payment he was paying the seller was getting.
Oh my
It could be
gosh.
50%, it could be 100%, it could be 10%.
Okay.
Probably half, if I was to guess, maybe, because you have to incentivize
I
the
bet
seller
you.
to do
I
this.
bet you, if I talk to 100 people that I know have been doing real estate for the last 5-10 years, they probably no one has ever done an amortizing.
I bet
lease.
1,000 haven't. Yeah, it's
Wow.
crazy. I mean, these weird deals always seem to find me. I don't know why, man. It's but
But I love that. So then it
because
basically
you figure you get creative and say, okay, this
the
store
banks
got
can't call it
Yeah.
a loan due if it's a lease.
Yeah.
You can lease a
no
property.
deed was recorded, no warranty deed was recorded, and then this guy got his stuff together in a year and a half. And
So he managed everything,
Yeah.
and then he was able to buy the property in about a year and a half.
Yep.
Wow.
worked out great.
Wow.
I was sweating bullets because I'm like, oh.
And so, but the amount that he bought it for went down over time.
yeah, and I don't remember all the numbers. I
But
mean, it
still,
was, but yeah.
just that creativity. But then
Oh,
you had a
absolutely.
great attorney that was able to put
Well,
everything.
think about this: if he got 50% rent credit.
Oh my gosh.
Think if he owned the thing on a seller carryback, he's probably got what 5 or 10%
Yeah.
of the payment going toward principal reduction.
Yeah.
This guy had 50%. I don't remember what the number was, but say it's 50%.
Okay, so lease that. So I know a lot of my friends out there, and shout out to some of my mentors out there that have taught lease options.
Yeah.
A lot of them love lease options, and then when they're doing it for themselves, they'll do the rent credits.
'Cause
They
it's
don't
a
talk
good way
about
to-
that very much anymore.
It's a good way to do like a
Pound down the principal,
Yeah.
right?
it's like a 0%.
How hard is
man.
that to negotiate a lot of times? I always think of everyone thinks this is so adversarial, but really most of the time it's just if you ask, you don't get it if you don't ask. Right?
Exactly. And the thing is I once heard the phrase, a confused mind says no.
Okay.
So I think my problem is my mind goes 100 miles an hour. I'm thinking everything's bouncing. I just have to say, all right, slow down.
Just give them the basics.
Yeah.
That's Dave for you. I love it.
But I think the trick is a lot of times you have to understand like the type of people I've dealt with. I'm not dealing with the guys that are up in the top floor of the skyscraper.
Okay.
I'm dealing with a lot of blue collar people, which I love and respect. But in obviously, if I'm buying something, I'm representing myself.
But they're
and my own
probably,
interests. But I'm trying to help them, man.
Yeah, you're trying to help them.
They're trying to get out of this thing.
They may have bought 5 to 10 houses in their whole lifetime.
Yeah.
So
Yeah. Absolutely. So it's like, what can I do to make this fair and equitable?
okay,
Because it's just like anything else. I mean, the
it
golden
has
rule.
to be a deal for you too.
Yeah, it's got to be a deal for me. But I just have to look at, hey, if I was dealing with my grandmother,
How would you? Like
how
them to
would
be treated?
I want someone to treat her? So you treat them, and it's like anything else. I believe in just transparency. Hey, this is exactly everything I got. I mean, this is what we're doing. If it goes south, this is what you'd have to do. You'd have to foreclose. And the most important thing that people don't realize is on a wrap, when I've sold properties on wrap before, let's say I sell it to you. If you're not paying me, I still have to be coming out of pocket and paying the underlying note.
Yeah.
And a lot of times people don't have that, where if I'm doing a transaction where I'm the broker and it's my seller, I'll say, tell you what, this buyer's giving you 20 grand. Do me a favor and pay your underlying loan ahead 3 payments.
That's what I was just going to say, because I've heard you say this multiple times, where if the seller gets a chunk up front, you give them that advice to say, look, just in case you have 3 months now that are kind of like a little grace period.
You're buying a cushion, because what happens is, and this is the other thing too, the seller doesn't realize, and it's important to disclose to them. And there's I have addendum like this long of all the stuff that could happen on an owner finance deal. The note could get called. There is a due on sales clause on a conventional loan. And then the seller's credit's on the hook, man, not the buyer's. So if that payment's late, because you have to understand, you're sending the payment to account servicing. They might sit on it for a couple of days, and then they're going to bounce it out to whoever
to the bank.
Yeah, absolutely. And I've had some crazy deals before where I did on a commercial building. I did a wrap, and I had to have the account servicing company made me sign off on this big time because they were really worried about it. They said either you're really savvy or you're a complete idiot. And I said, yeah, your guess is as good as mine. We had this one deal. I bought this tire shop, and the seller had a loan, and he got it back in the day when you refinance something. They'd always give you like a 0.25% discount if you would have the payments ACH'd.
Oh, okay, yeah.
You know what I'm talking about?
Yeah, automated. Yeah.
So, it kept going out of his thing. So we did a deal where, out
of his own checking account, kept going out of his own checking account.
Yeah. Okay. And what was crazy was, and I knew the seller, and I didn't know him, but sometimes you just meet people and you just trust them. And it could be.
Wait a second. Are you going to say that you gave him the money instead of have the note servicing company?
No, I gave the money to the account servicing company. They deposited the money into his account, and then it got swept out from there.
And he never missed a payment, or?
As long as he had money in his account, it was fine.
Wow.
I wouldn't do that to anyone else, but I know worst comes to worst, I get burned one month.
But he had a tire shop. It was a business, right? It was a.
No, but what I'm saying is if he bounced it out once, whose credit would it screw? His, not mine.
Yeah. And
then if the payments didn't get made, he would have to foreclose on me. And then it just, there was nowhere bad for it to, there's limited exposure for it to go sideways in my mind.
Got it.
So, and maybe I'm a complete idiot.
So question here on lease options. And this is something that when it comes to control without ownership, a lot of guys I know do lease options, and they love it, and they'll use it for like Airbnb and short-term rentals too. And a lot of times the sellers are starting to get savvy where they know, hey, I want a big fee. I want you to give me a big option fee to do this.
Oh, interesting.
And so some of the guys I know, instead of giving them, they say, okay, fine, you want say 5,000 instead of just 1 month's rent. Typically it's like a month's rent or something like that. Then what they'll do is they'll say, okay, what we're going to do is we're just going to prepay rent.
That's interesting.
5 or 6 months.
Okay, yeah.
So they get their money, but it's prepaid rent and not a huge option fee. So it still goes towards.
Yeah, they're getting credit for it.
Yeah, they're getting credit for it. And now they're not necessarily, it's like going towards that future purchase or whatever. So.
And I don't do I've done a couple lease options, but what I found is it wasn't my thing.
Well, if you can do an agreement for sale, why do a lease option? Right?
And I've sold it on. I've never bought anything on because I always like, hey, I've got stuff with next to nothing down, and I'd rather own it as an agreement for sale or through a warranty deed.
Well, then if you sell it at lease option, it's even less on the totem pole. Of strength for them. It's more strength for you as a seller.
Yeah, and sometimes you have to be careful too when you do the lease option, whether you're doing it one agreement or two, if they're developing an equity position. Because a lot of times people don't realize like I said, I'm not an attorney, but I've just kind of dealt with all these crazy deals. And I'm usually the guy buying it, trying to unscrew the stupid thing. Where
you're solving a lot of problems.
Oh my goodness.
Yeah.
So like there's been times before where I bought it and the guy foreclosed. I bought it from somebody who foreclosed on the previous tenant buyer or whatever, and the tenant was still there.
Yep.
But anytime there's an equity position, you have to take that person to Superior Court to extinguish that.
Oh wow.
It's crazy. It's crazy. Or if the dollar amount's over a certain amount.
Is it okay if I go through a few
yeah,
questions?
Go. Let's do it.
Okay. So I have first question is, do you buy subject to properties in 55 plus communities?
I've done 55 plus communities. I mean, I bought them and I flipped them, and I bought them and I rented them. You and I even had a discussion at lunch about I had trouble renting some of them.
Not so you don't do subject to, but you've done like the wraps and stuff.
Yeah, I've done
carrybacks.
Yeah, and I've owned in retirement areas, and it's anytime you restrict certain people to be able to buy. I mean,
the pool goes a little smaller.
It does, and I'm not saying it's good or bad. It's more restrictive, which in my mind.
And one of the things we were talking about at lunch was like maybe that's not so bad because sometimes maybe older people take better care sometimes, but
everything's got its pro and its con.
Okay, here's a question from our buddy Travis. I have no money and no job. How can I buy a house?
Figure out why you don't have any money and don't have a job. Chicken Travis. Man.
I know.
That goofball.
So, okay, Mr. I buy a house.
No, I mean, and in all seriousness, I mean.
You need to figure out a way to pay, right? He threw you off your game, didn't he?
Oh, Travis. But you know what I mean, no money's not what you're saying is the money's not coming out of my pocket.
Yeah.
You know, so I mean, I've cashed events credit cards to buy houses before when I first got going. I mean, this is not any time lately, but you know, I've had people secure seconds on properties that I was buying and paid them a decent interest rate. I think the caution I would say is this is what a lot of times people buy anything if they can get like subject to or wrap or whatever. The reality is you still owe that money.
Yeah.
That's and see the problem. I think
you're taking on a debt.
You're taking on a debt. And in my own, you know, the way I was raised is you sign your name, you back it. Regardless of what happens, you make it right. I mean, it's just, I mean, it's old school and it's kind of. But,
well, I know one of my friends, very creative financing, but he got stuck with some subject twos, but because he was a man of principle, he paid those until he could sell everything because he felt obligated. And instead of letting them go to foreclosure or turning them back, he kept paying it, even though it just drained him.
And it's tough. I mean, it's real tough. And I think in Arizona, I mean, for the most part, unless you're doing any kind of recourse loans, most of it, the properties are subject, you know, the sole collaterals usually. Yeah. But I think though that, I mean, if I get the seller into the situation, the last thing I want to do is screw them. I mean, it's, you know, and what I'll even do too is I used to carry my credit report. Now you can just carry it online or you can pull it up. I have the identityguard.com. You just pull it up and say, hey, here's my FICO score or whatever. But back in the day, I used to have a briefcase. On wheels. You know it. Heck yeah, man. That thing was sweet.
With wheels?
40, yeah, it was like a suitcase.
You carried around your credit report.
Yeah,
was there whiteout on it or anything?
But I would just pull it out and just say, listen, I have nothing to hide, man. Here's my credit. There's no, and the thing too is one thing I'm proud of is even during the entire downturn, I never had one 30-day late on any obligation I ever had, ever. 30, you know, I mean, during the time I never let the crap go. I mean, and that's the thing is everyone I thought treated mortgages like an option, you know, like, hey, I got a mortgage on this house. Oh, the price went to the roof. Great. Let me cash out and make some money. Oh, the thing just plummeted. You know, here's the keys. Adios.
Wow.
You know,
so a lot of people.
And that's why I think there'll be opportunities in the future because we opened up Pandora's box, which is called short sales.
Well, when I was working at Wells Fargo during the downturn and stuff, so there was a rule. If you were a mortgage professional, an underwriter, processor, originator, if you had a foreclosure, basically you meant bye-bye.
Oh, really?
Yeah.
Interesting.
You were let go. But because so many people went through that and so many people got hit, like
the new norm. Yeah,
that was an exception. They changed that.
Yeah.
So Mark Boyd says the 10B2 calculator is a good one, and you can find it on Google Play Store.
Yeah.
or Apple.
Yeah.
No
boy.
Android. Sorry.
ET photo.
Fernando's Hey Camp. Mark also says the verbiage assuming a loan, I think in the seller's mind that you are taking over the mortgage, I would say, I will pay your mortgage on your behalf. Be careful with the verbiage, he says.
What do you? Well, no.
I think I'm just like, you just got to have the right paperwork.
Yeah.
And make sure that, I think the key is just really disclose, just fully
Yeah.
disclose
And
everything.
this disclosure I have is like, listen, the borrower has equitable title, not legal title. The seller's on the hook for the loan. If it goes south or the guy's late, it's going to ding his credit,
Right.
And then the seller might, and that's why I've never done the the subject to. How do you foreclose on a subject to? If I'm just deeding you the property and you're taking over my loan, what financial instrument do I have if I'm the seller that I can take that property back? And maybe there is, maybe it is, I don't know. I usually just do, that's where agreement for sale. I can explain to them the law because I've read it, where it's just like, listen, based on this equity, your foreclosure timetable is this, that, or this. So
your go-to, if they have a loan, is a wrap, is an
agreement for sale.
Agreement for sale / wrap.
And like I said, that's in the law books. That's where I only saw where I just said agreement for sale or deed of trust.
Okay.
Just,
And
those are the two prevalent.
The seller
ways.
carryback is like the deed of trust you're talking
Yeah,
about. Right?
you could probably even sell it free and clear on an agreement for sale if I was worried about a low down situation and I didn't want it to go on a sale.
So let me ask you this. How has understanding these creative solutions helped you in your real estate career?
I once had a buddy say this, and you have to, depending on where the market is and the timing, but he said, what you owe today is what you could be worth tomorrow if you do it right. You know what I mean?
Wow.
Because think about it, this guy,
what you owe today could be what you're worth tomorrow.
Yeah, it's like, no matter what you do, that loan's going to get paid off in 30 years, even unless you do an interest only, which I wouldn't do.
Right.
I mean, any long-term strategy, I've always been about get out of debt, of debt. So I think I just lost my train of thought. What were we talking about?
How's it helped you?
Okay.
How's it helped you in your career understand these creative strategies?
Well, because you got to a point when I first started, man. I couldn't get a loan to save my life because I didn't have bad credit. I just didn't have any credit. Yeah. And I did those FHA assume no qual. So you just had to pay, I think, like $45 or $125, and you could assume it, man. You had to be a mammal, have a pulse, and they gave you the stinking deal. It was
fog the mirror, right? Yeah.
And then I started using my credit cards to cash advance. And what was crazy is it killed my FICO score. I didn't have any.
So you're telling everyone that they should go ahead and take all the cash out of the cash advance?
No. Don't be a knucklehead. Like I was.
But you did that.
But I did it, and it's like anything else where, depending on where the market's at, it's just like, nobody knows that you're swimming naked until the tides retreat. So,
oh my gosh.
So
that's the Davism right there. Yeah. We have to write these down. We have to like have a little chime, like ding, like every time.
Or what is it? The thing where the tide raises all ships, and it's just like, I think when the market's low. When the market was low last go around, I leveraged to my eyeballs, man. I was just, borrowing, but it's just like, hey, is it bad to buy a house for 30 grand and finance it? I didn't even finance it 40 because I needed 10 grand for the renovation.
Okay.
But I only had 40 grand on it. Now it's like, heck, you pay that same house is 225. Even if you put 25 grand down, you still owe 200. Who's better off? So, but
you could still cash flow.
Oh, absolutely. Now it's like, I think the biggest thing now is two things. One, don't use too much debt where it doesn't cash flow. And that's what got a lot of people everyone had this mentality. If I own real estate, it's going to go up forever. And they lost track of
Whoa, are you saying it's nuts?
Hey, man, just everything's circle of life. Everything, everything changes. And my point is that.
And I'm laughing because this is something that Dave just pounds into my head about market cycles. We got to understand market cycles. We got to know what to do when the market's stagnant. We got to know what to do when the market's going up. We got to know what to do when the market's going down.
Because I think there's going to be different streams of income that come and go.
Yeah.
Like right now, it's tough to find the deals, but it's easy to find the money.
Right.
When the market's low, it's easy to find the deals, but it's tough to find the money, and then there's a sweet spot in between where everything's, harmonious in the world.
Tell us about one of your favorite creative deals that you've done.
Oh man!
If you didn't already share one, you didn't share one of those. Probably one that just kind of like this makes you smile.
I did a couple of zero interest loans. Those were fun because every month
it's all principal.
Yeah, you're basically telling a tenant, hey, listen, I'm going to put you in this house, and you're going to pay this guy off for me. I mean, seriously, that's what it's hilarious. So those were fun. I did this, and then that was cool to walk the mortgages elsewhere, move them somewhere else. That was totally cool.
Walking the mortgage, substitution of collateral.
I liked when I bought loans, bought mortgage or bought notes,
bought some notes.
Yeah, bought some notes. Those are fun. Did real well.
Have you created very many notes?
Oh yeah. I mean, hundreds.
Wow.
So those are fun, and
there's no real. You can get as creative as you want.
Yeah, there's one deal, and I didn't buy this one, but I brokered it. It was really interesting. So it was a commercial building, and they wanted to wrap the loan, but this is what's really unique about the deal. And I don't remember the exact numbers. Let's just say they bought the commercial building, and maybe there was a loan on it of $200,000, and they're wrapping that. And I don't think it was an exact wrap. I don't know if there's any equity involved, but they put $50,000 down. Okay. But this is what was crazy. The borrower/buyer wanted the loan amortized a longer period of time, and he wanted his payments to be $1,000.
Okay.
But the problem was the seller, the owner of the property, had a short amortizing loan, and he was paying the bank $1,500 a month. So there's a $500 shortage.
Oh wow!
That wouldn't be covered. So I'm like, okay, how can we structure this, man? Because this thing was a tough place to move. It was a weird deal. It was a downtown, and one of these old downtown deals in Tolleson, I think it was. But so what we did was I said, tell you what, you're getting this $50,000 down payment. Let's take $20,000 because the loan was like for couple of years, 2-3 years, something like that. I said, let's put enough money in the impound from your funds to cover the shortage or the deficiency. So you put $20,000 in there, and every month
it just popped
the $500 out to cover the payment. So that's what I'm saying. There's cool. If everyone has a creative mind and open mind, you can do just about anything, man.
So do you feel like that? I think one of the questions that I always think of is when I first started to get into the creative financing deals and stuff like that and deal structuring, is I thought that a lot of people would be very standoffish or like adversarial against the idea. But most of the people, and I don't know how your experience is, most of them it's a simple yes or no. There's not a whole lot of emotion. And if I explain it correctly and I explain that they're going to have so much more in interest over time.
Oh, absolutely.
They're like, okay, so you're going to pay me more than what I'm asking if I get interest?
Well, and think about a 30-year note versus a 15-year note. And I don't know what interest rate it had to be at, but typically it'd be a higher, probably single digit. You typically pay 3 times the amount. A $100,000 loan, you might pay $300,000 in payments and interest and all that, and then $150,000 on a $100,000 note on a 15-year. And my point is that, like you said, there's a reason the banks they're in big skyscrapers and towers, and because they know how to make money on the money. So I would think that this is every time I pitched it, I always ask for owner financing. Always. Absolutely. And it's like sometimes I used to even I'd put in 2 offers.
Yeah.
And I'd be like, okay, tell you what, I'm going to buy this for $100,000 cash. I'm going to buy it for 130 with 5 down. You pick. People almost think they have to pick one. There's they don't have to say, I don't want to go fine. I'll take that one on the left, So, but I think
behind door number 2, right?
In some, and I've done that where and sometimes even on the realtor contracts, you can write in the additional terms. It's like, hey, $130,000, $5,000 down owner financing, or there's a cash price of $100 cash, close in a week, whatever.
So let me ask you this question. So there's a lot of realtors out there. You're a realtor too. Whenever you're buying homes and you bought some off the MLS, I'm assuming, with realtors involved and stuff. Whenever you pitch this,
the seller's not the problem. I can't tell you how many times. And this is the trick is you have to understand not most, but some realtors have egos. And that's not even an ego. It's the fear of not knowing and then having somebody else know that they don't know. It's not the ego. It's the fear of, hey,
They're supposed to be a professional.
They don't know what they're doing.
Yeah.
So this is what I did. As soon as I got the realtor or the broker on my side, it was a piece of cake. And sometimes I say, listen, you know what? I've done quite a few of these. You may not be as familiar as I am. I'm more than happy to walk you through this thing because our sole objective is to make sure we get this thing closed and take care of everybody.
And they get their commission.
They get paid.
Yeah.
You know. So and I've gone in front of sellers with their broker next to them explaining this. I remember the first VA wrap I did it like, I forget what, I don't remember who it was. West USA, somebody, I don't know, some agent, a realtor. And it doesn't matter what company. I sat at their boardroom pitching to their seller with them there. Yeah. And like I said, I don't remember what brokerage it was. I guess it doesn't matter. But it's like, and then I gave them information and I left because it's not my job to have their agent coerce. She was a great agent. Yeah. She was a phenomenal agent. But she goes, listen, you're going to be able to explain this better than I could. So I went in there and this guy had owned multiple properties. This thing's been on the market forever and he couldn't unload it. It was a dog.
And they want to help their clients.
Absolutely.
Too. Yeah.
They just, like I said, a confused mind says no. They just didn't know what they didn't know. And I just said, hey, this is how you do it. I'll take care of the paperwork. And then they can say, okay, you know what? That sounds all right. This guy's good. He's got the credit. Okay. And, we can do this and that. And I've done that before many times where I've pitched. I won't say, hey, you need to sign this. It's just like, hey, it's her job to consult with their client and then let me know if they're on board or not. But yeah, it worked out great.
I've done a ton of wraps and seller carrybacks, and I've never been asked for my credit report.
Really? And you know what's funny? I always, because mine was great. Well, it's so I always just offered it just to.
Yeah, I mean, mine's good. But I guess it's interesting.
Nobody's interested.
They're not. I guess most of the time, I guess it's all how you present yourself too, and I think the key is you're just giving them a solution. It's just one of many solutions. I can give you cash, but it's going to be lower. I can give you your price, but it's going to be on my terms.
Yeah. And there's a box on the actual realtor one that says, okay, it's contingent or not contingent upon the credit report. So, and that's where sometimes where they'd want it or whatever. And I would supply just if it took that one guy from California where I was putting the money, he was putting the money, or we're putting the money in his account.
Yeah.
His wife was really skeptical on it. As soon as I showed the credit report, because me offering to do that, he was thank you so much.
Wasn't more than
I just took any doubt she had off it,
Yeah.
So
I like that though. It's not about it because I think about it like when you're trying to get private money, people put little packages together. Yeah. You put a little package. This is
why you should bet on me.
Yeah.
So.
And it is you, even though it's maybe under your LLC or something like that.
But yeah, there's still somebody, the person,
Yeah, there's a person behind the LLC.
There's got to be somebody that's,
Any parting advice? Any parting advice that you'd give to people that are maybe they've never done one of these deals? Any advice you can give someone like that?
Yeah, and I think you were going to put it on your contact thing, and I think too a lot of times what people do is they think they have to figure out everything on their own. They think they have to know everything. You know what I mean? Right. And you can't. And I think you need to surround yourself with intelligent, educated people that are going to help you through these things. And that's, I love what you do, where you help people out all the time and educate them on how to do this stuff. You know what I mean?
Well, I learned from a few people.
As did I, and I think if you're the smartest guy on your team, I mean, your team's in trouble.
So, that's true.
But, let me look at my notes real quick. We talked about wraps, finance 0%. On this stuff, I think the main thing would be is to don't be afraid to ask.
I love it. That's it.
I can look at all my stupid notes. I'm like, you know what? I did a deal the other day where in this market, and they wanted, I forget what percentage it would be. It was probably like 35-40% off the price, but I got it.
How many, and I know it's hard to maybe quantify, but over the years, if you're just going in with your deep discount cash offer strategy, how many, let's say you're going at bat, and let's say you have 10 appointments and 10 of them are kind of stuck on their price.
Yeah.
and you may get how many on a cash?
Few.
Oh,
I mean,
so-
versus the terms.
So maybe 2 out of 10, and then how many on terms?
You could get because everyone wants their price, and let me punch in something in the
So you can get a lot more.
Absolutely.
Your success rate can skyrocket if
And
you understand this.
let me put in something that'll be kind of interesting. So let me just use $100,000, and I'll do a 15-year loan. Let's just say it's a straight loan, and let's just say if you could.
So he's using a special calculator. Typing in the formula and the numbers here.
Okay, so I think the most important thing is know your numbers. Like I can't tell you how many times I pulled out I used to have one of the old HP. I had the 19B like this, and it had all these stuff, and it's like $200. Now you can buy the app for $5. It's insane. So, but like back in the day, I used to have to know like at a split second. They're like, okay, you know what? What about I want my payment at $800? So I'd have to do it backwards. I need to figure out how long the amortization would have to be. So this is what's really interesting. 15-year loan, 5% interest rate, $100,000 loan, your payments $790. So say $800. Okay. If you had to go get a hard money loan with or say even a higher interest loan, at 10%,
which are usually interest only.
Yeah. But let's just say even if you went to a private party that did 10% loans, right? Like a loan that's for 15 years, you're losing $26,000 in purchasing power. Does that make sense?
In what way?
So let's quantify that. So let's just say if your payment's going to be $800 at 5%, you can get a $100,000 loan. A $800 a month property at 10% interest, you're only able to get a $73,000 loan.
Oh,
because your payments are this. Does that make sense?
The payments are the same, but you
lose
have
that
less
purchasing power.
Yeah.
And that's the thing is I guess my point is I wouldn't say pay a premium, but you can pay. The lower the interest rate is, as long as you're going to hang on to this thing a long time, it has to be. You could almost pay a premium or more than this is based on a 15-year loan.
Right,
so,
right.
So I'm not saying pay a premium just because you found some sucker to do 3% and pay twice as much. But my point is you can really finagle the numbers.
You just nailed this. You're basically it's almost 25. I'll just round to
25. Yeah,
25 grand.
Yeah.
So basically, you're just creating more buying power.
Absolutely. Or you could say you're getting a $25,000 discount.
Yeah.
Because you got sweet, soft, easy money.
Yeah. And you're helping them still understand and still get their price, but you're able to get this. But I think the best advice you just gave was ask.
Absolutely. Ask.
People don't do that.
Ask and you shall receive.
Yeah.
Usually.
Yeah. Well, I mean, yeah, but if you don't ask, you won't get it.
I can guarantee 100 out of 100 times if you don't ask, you won't get it. Unless I've had some where, they want to sell, or that one commercial thing. I said I wouldn't sell unless I carried, But yeah, 99 out of 100 times it's not going to happen unless you ask. So.
Well, before we wrap up, I just want to see if there's any other questions. If anyone has any questions, throw it in the chat right now. I think it's great advice. I think the biggest thing that I also took away whenever we did a lot of wholesale deals. We assigned.
You guys did tons, yeah.
We assigned a lot of wraps, a ton of wraps, and I think we would probably get 2 to 4 extra deals a month just because of wraps.
Yeah. Or think about the premium you got on the pricing.
Yeah.
So
I mean, so something that wasn't going to be a deal or a wholesale deal even, now we created something out of nothing.
Yeah.
It made something out of that.
Well, and even think about this. I mean, why do people even borrow hard money? Because they can't get money. So they're willing to pay a premium for something. And there's an add value to it. And that's what I say is, heck, you could buy this and flip this at the same price if you're, getting it at 3 and selling it at 7% interest.
Now, if anyone that's watching this or listening to this on the podcast and stuff like that, and or reach out to you off social media, is there a way for them to reach out to you or to get a hold of you?
Yeah, I usually just email azbroker2000@gmail.com.
azbroker2000@gmail.com. Dave, thanks so much for being on here. Appreciate it.
You the man, Brando.
And if this information is helpful to you and you want to be able to understand how to do more of this, let us know in the comments. let us know what you want, because I mean, there's so many types of real estate investing strategies out there that people don't even know about.
Well, and I got to give a shout out to you too. I mean, the amount of information you've been able to help people with, and give people and give them opportunities with no catch. You know what I mean? Where you're truly a giver, where you're always. I mean, heck, group, even the Go Givers, is all about helping others out. I mean, it's amazing. I mean, just how many people you've been able to help and enrich and bless their lives, just sharing your time, talent, and abilities to help others out.
Well, thanks. I have a great example. I got a lot of people to thank, but really, thanks so much for watching, and thanks so much for listening. If there's anything that we can do for you, please reach out and let us know. reimastermind.com. If you haven't already done so, join the Facebook group, the official REI Mastermind. And thanks for being here. And Dave, thanks to you. Appreciate it.
Hey, thanks, buddy. Is it done recording?